So again, my name is Bill Jung. I'm one of the coaches at North Idaho Small Business Development Center. And again, I want to welcome you to how to get a business loan. So this webinar, actually, it's not a webinar. It's more of a panel discussion with three outstanding lenders from our community. So if you are in business and you're growing and you are thinking about getting a loan to help you grow and you have some questions, this is the right place. If you are thinking about starting a business and you're thinking about getting some funding to help you launch and you got some questions, this is the right place. So before we get into the panel discussion, let me just share a little bit about who we are, why we're putting this on, because I think it will be good news for some of you. So who are we? So we are Idaho Small Business Development Center at North Idaho College. Okay, why would we be good news? Well, because our team, our mission is to accelerate your success. That's our mission. Mission obviously being, what's our purpose? Why do we exist? We exist to accelerate your success. Because when you're succeeding, that means you're blessed, your family's blessed, your employees and their families are blessed, and hopefully the customers are blessed, and that is good for our community and our region, and so that's why we exist. So that's our mission. If that's our mission, what's our vision, right? Vision it would be, if we believe our mission and walked it out, what kind of future could we create that would be worthy of the years walking it out. So our vision is to help build world-class businesses. That's our vision. So why world-class? Well, because if you're world-class, that means you're solving a meaningful problem and you have a compelling solution. And if you're solving a meaningful problem with a compelling solution, that means you have margin and you have profit and you have cash flow and you have sustainability, right? And that's what a great business has. So if you're doing that, chances are it's not just the people that are local who have that need that you can solve, you can meet. Chances are there are people beyond local in the region who have the same need you can meet. That means you could actually try to reach them, become a regional business, and maybe even a national business, maybe even a global business. Right? And then you bring money back to North Idaho and grow a world-class business. And when you have a world-class business, that also means you have world-class jobs. And people with world-class jobs have different economic opportunities. And that is so good for our community and our region, and clearly would be good for our country as well. So that's our mission and our vision. There's 9 of us, and all of our business coaches are retired executives. And they all work part-time or are volunteers. And so we say we have 350 years of mistakes we want to help people avoid. We're not magicians, but we have scars. We've been down the road. We see, we can smell stuff, and then we can help you kind of not do the stuff that we've done. And you can make your own original mistakes, right? And so that's who we are. And our primary offering is coaching. It's one-on-one, confidential coaching. And then the second thing we offer are training and webinars like this. Oh. And we have many other webinars coming up, just this month and next month. How to improve profit. People think, as you know, people focus on sales, but the name of the game in business is profit, right? And then we have marketing strategy, and it's all about value proposition. Thinking about starting a business, that's for you. And people think business finance is for paying taxes. No, it's your #1 intelligence, your performance metric. You got to know it to make good decisions. Overcoming legal pitfalls, digital marketing, e-commerce, social media, you got to know that stuff in this world, in this new world. Hiring winners, because ultimately your #1 competitive advantage is your people. So you got to know how to get good people, keep them, and that will be a difference maker. So and then you are welcome to check out many others at NISBDC.com. That's our website, NISBDC.com. Okay, so we have 3 outstanding panelists. So I'm going to start with Rob Stewart. Rob is Vice President and SBA Loan Officer with Columbia Bank. He's been in banking for over 35 years. And so Rob, what else would you like to share with us about you and about Columbia?
Well, yeah, Bill, thanks for inviting me to join. And I cover all of Idaho, the whole state, and Eastern Washington for Columbia Bank. And my primary task is to assist our commercial loan officers and branch managers in working through and getting SBA loans booked, specifically 7A loans. And I'm born and raised in Spokane, so I know the area very well. I have been in banking for, I've said 35 years for probably the last 5 years, but anyway, a while. And have gone through some economic cycles. And so I, like Bill had mentioned with his team, you know, that's one thing that I like to bring to the table is that experience. And hopefully, you know, then guide our borrowers and hopefully help them to avoid mistakes that I've seen in the past.
Okay, great. Thank you, Rob.
Mm-hmm.
The next panelist is Megan Halsey. And Megan has been very active in the entrepreneurship arena in Spokane area. She was a director of Startup Spokane and currently as a business lender for Craft 3, which is a CDFI. And that's really, okay, I'll let Megan explain CDFI, because I think that'd be good news for many of you. Okay, Megan?
Hi. I have been in lending for only about 2 years, so I'm still learning a lot from my peers and colleagues. But I have been involved in the business community for much longer, so I have some experience, some real world experience that helps a lot of my clients as they navigate the new business ownership realm. At Craft 3, we are a CDFI, Community Development Financial Institution. And what that means is that we are a non-bank lender. As a non-bank lender or a non-credit union, we don't have the same regulations imposed on us by federal restriction and law. And so we're able to be a little bit more creative and take a bigger swing at helping getting our clients up and running. We don't take deposits from our clients. So we're not competing with the banks or credit unions. In fact, our goal is always to get you start your business, help you renegotiate your finances or get you back on a good playing field again, but get you back to your bank within 5 years. So typically my clients are what's considered non-bankable. That means that either you don't have a good enough credit history, you don't have enough collateral, you don't have enough background to start the business for a traditional bank because they have to meet a bunch of requirements that are legally required. So I can take you on. But the challenge with that is that because we're taking a bigger risk, you're going to pay a little bit more in interest when you work with us. But as I said, our goal is always to help you get into a position where you can get back into the bank as quickly as possible. So that's what we do. And so the majority of my clients are in that early stage startup. And that works out really well for me because I'm really passionate about early stage and startup companies. And the crazier your idea is, the more fun we have talking about it and trying to figure out whether it actually will work. So yeah, no, so I love what I do. This has been a really fun journey. And, I love helping people refine their ideas to get a business that actually can function and grow and become world-class. And the one thing that I want to clarify that Bill was talking about world-class, solving a meaningful problem could be as simple as providing a great cup of coffee at the right place. So don't let it scare you. You don't have to become Starbucks. You can be Jitters. And that's still a world-class business, in my opinion.
Okay, great. All right. And last, we have Mike Shortell. Mike is Assistant Vice President at Numerica Credit Union. He's also business SBA team leader at Numerica, and he's been in banking for 22 years. Mike, what would you like to share with us?
Thanks, Bill. I appreciate the opportunity to be here with you and talk about this stuff that I really love to talk about. I'm with Numerica, like you said. We cover all of Washington, Idaho, and parts of Oregon in our footprint. And we're a member-driven credit union. We have a full suite of business services, which not every credit union does. So we're a little bit unique in that sense. And I like Rob, I primarily work on the 7A loans. And we've done all kinds since I've been here, startup to ownership change to expansion to real estate. And I think that the kind of what's a little bit unique about Numerica is we are member driven. So we try to find solutions for our members that, make sense. And so we're willing to, I think, take a look at things that maybe some places won't take a look at. And so we're not in the craft 3 range, but we're definitely a little bit more expansive than some banks are. So, but no, I love talking about how to get a business loan and I love a big part of my job is coaching businesses. And when you do deal with a lot of requests for startups, you spend a lot of time just coaching more than you do lending a lot of the times, but it's always a long-term relationship. So you might not be ready now, but we can get you ready in a year, or we can get you ready in 6 months, that sort of thing. So we take that role seriously, and we like to help, our members expand and grow. So.
Great. Thank you so much. Okay. So we have a kind of a rough agenda laid out for this morning. But we don't have to cover this. We'll cover whatever questions that you may have. So you're welcome to write a chat or speak out when there's a gap in time. But so we're thinking, tell some stories about recent businesses that actually got a loan, why they got a loan, and the ones that didn't get a loan. Typical mistakes that you 3 lenders look for. That you don't want to see, the things that you want, the things that you want to avoid, and then some of the programs. Mike just mentioned 7A, and we'll unpack that a little bit, and then some application processes, and then also industries and businesses and stages that they like to lend on, and Megan talked about that a little bit. So let's just kind of go, starting with Rob. Can you just a quick brief story about a business that got a loan recently, and then a business that didn't get a loan, or maybe a person who didn't get a business loan?
Sure. I'll start off with the loans that I just haven't been able to put together are primarily driven around the borrower's experience, especially now in these challenging economic times. We're really leaning on that. So if you've been, even though perhaps you've been a head chef for several years, and you want to buy the restaurant or start your own, there's obviously more to running a restaurant than being an outstanding chef. So together with experience, we really lean on a solid business plan. And that's where the small business development centers really can assist in putting that together and covering all the topics that you should think about when you're starting a business. And so really lack of experience has been a hurdle that we have been difficult for us, Columbia Bank, to get around recently. If you look at perhaps buying a franchise, that could help mitigate that. But still, we really want you to have some experience in whatever industry you're looking at. For successes, I have funded several business change of ownership or business acquisitions recently, and those are always fun. Typically, it's the current owner has done a very good job at promoting or starting that change of ownership with some of his key employees. And those are much easier to do because obviously they have experience and they with that industry and that business. And yet we still want them to have not necessarily a solid business plan. I refer to it as a solid transitional plan. Okay, Susan or whatever, the current owner has most likely built that business up for the last 20 years, 20 plus years. They've lived it, they've breathed it day in and day out. And so how are you going to transition that person out? Because if you use an SBA product to fund that, which is probably, one of your only real routes to go, would be, SBA only wants that current owner to hang around 1 year or less. And I get that because they want you, the new owners, to take over and run with it. It's your business now. So we really look towards a solid transitional plan in that case.
Great, thank you. Megan?
Okay, so for us, what I really look for in a borrower is character. Most of my borrowers are not suitable for a bank for a number of reasons. Like Rob was mentioning, they may not have the depth of experience in the field. They may not have sufficient collateral. They may have a pretty scarred up credit history. So what I do is I spend a lot more time talking to them about what's going to make this work, what's going to be different, and finding out whether they're willing to work with somebody like the SBDC to do that one-on-one coaching, to put in the work of their business to make sure that they can successfully run and operate the business. So the first thing I look for is somebody who can take advice and guidance and be coachable by myself or by the people that we work with in our community, like the SBDC. That allows them to put together a business plan. I'm a little more flexible with your experience in the industry. But what I will do is lean on some of the resources that we have in the greater community to help them beef up that part of your business plan to make sure that you understand what you're getting into. Some examples of businesses that I've been able to fund are, a lot of them are employees who are branching out on their own. So I had a diesel mechanic, somebody who does work on big trucks, tractors, that kind of thing. He's actually took out a loan with us October of 2019, and he's just paid that off and taken out a new loan for a bigger truck. He is a hair's breadth from being bankable. He just needs a little bit more time in the industry, and then I'll be turning him back to the bank he came from. So he'll be able to kind of make that transition back to have a full suite of services and a team that will service his needs going forward. And so for me, that's a huge success, is to see somebody build a business. And when he came to me, he didn't really understand much about his finances or his bookkeeping. And so we set him up with a bookkeeper. He's learned a ton. And the conversations that I can have with this business owner today are night and day to what I had with him when we actually put the loan together initially. The one thing that I will not do is I will not lend to anybody who expects me to care about their business more than they do. And you would be surprised how many people that is out there. They aren't coachable. They want to say, well, you're my banker, you tell me. And that is not something that I will tolerate. I will also not tolerate people who don't tell me the truth. So there was a mutual client that Bill and I had, or I don't even know if I would call him a client of yours, Bill, but he represented to me that he was working closely with the North Idaho SBDC on a food manufacturing business. And in fact, he'd had one meeting and he does not want to put the work in. And I actually had interactions with some other business coaching institutions, and he's hopped around North Idaho, Washington. He's now trying to work with someone over in Seattle because he's trying to get everybody else to do the work for him. That will never work if you want to actually run and operate a successful business. You have to be passionate about what you're getting into and believe that you can provide a service that no one else can do in a way no one else can do it. And then you have at least the opportunity to be successful. Anything less, you will not. So, and in terms of what stage, I'll do startups, I'll do basically recollateralizing companies that maybe have gotten over leveraged. We will do almost anything as long as it's the right person and the right time. We do have some focuses because we're a CDFI. So we really prefer to lend to minority business owners, immigrants, women, refugees, veterans, and also we lend in the agriculture and clean technology fields as well. So those are things that we'll get really aggressive with the risk that we'll take in those specific areas. But if you don't meet those categories, that doesn't mean that we wouldn't lend to you as well. It just means you may not get quite as good a rate.
Okay, great. Thank you, Megan.
Huh?
Okay, Mike.
All right, yeah, a lot of good stuff already been discussed. I think that, like,
So Mike, you're with Numerica Credit Union.
Numerica Credit Union, that's correct.
Yep. Okay.
I think as far as like someone, that gets, that we look for to get a loan, that qualifies. One thing that Megan mentioned that I think is really, really important, and it's the character assessment. One of the things that you have to come to realize when you're getting a business loan is that you're kind of creating this relationship with your banker that's going to last 7 to 10 to 15 years. Ideally, if you make these loans that are a little bit longer term than your typical auto loan or something like that. So one of the things that we have to do is we have to really try to assess that character because it's the behaviors of the business owner that are really going to make sure that the loan can get paid back and that they're going to be successful. And we can, we aren't an investor with that business, but we are a partner and we have a mutual interest in success. And so I think that one of the ways we can, when we meet people for the first time, how we assess character. I mean, there's your standard, what's your credit score and that sort of thing, but that's really just a number. What we really look for is like what Megan mentioned, which is passion. We need to know that you're going to be there when things are going well, and you're going to be there when things are not going well. And, you get that, you just have to get a sense of what your commitment is to the business. So some of the candidates that we've given loans to that maybe on paper aren't ideal, or they've got some weaknesses, can sometimes be made up with, the fact that they're going to be there night and day, and they'll be the first ones there to unlock the door and the last ones to leave and that sort of thing. And you can get that sense just from talking to people and then, looking at their past, financial success and that sort of thing. So those are the people that I really like to help and look for. An example of a business plan I saw once, it was a few years ago, but it was one of these interesting, it was a startup proposal for a kind of a variation on a common business, a convenience store. And the business plan at first blush was put together really well. They had experience, they had equity, they marked off all the boxes. But, as we do as part of the process in a startup anyway, is we really have to scrutinize the projections, and we really have to get comfortable thinking that they're reasonable and that they can obviously achieve a level of production and revenue to be able to pay the loan back. And, as we sort of dug deeper into the projections, we kind of pointed out a couple of kind of glaring mistakes. One was with the calculation of how much labor there would be to run this, and some other things regarding some, utilities and expenses that maybe they just didn't think of. They did a very good job of coming up with how the revenue side would flow, but we see this often a lot is people start with the top item, they project revenue, but then they get a little lack of detail in the expense side, and so the bottom line looks like it's going to do well, and could pay the loan off in a year kind of thing. And so we started pointing out some of this stuff, and it took them a couple of weeks, and they came back to us, and they had actually made corrections to the expense side, but when they kind of added it all up, it turns out that the revenue side wasn't going to be enough anymore now that the expense side was a little bit more realistic. And so after really doing a good job on figuring out how much revenue they could do, they just increased the revenue to make it work. And so the mistake is that you have to be, it has to be reasonable on both sides of the income statement, right? The revenues have to be reasonable and the expenses have to be reasonable. And if you're going to do, if you're kind of penciling it out and you come to find that, you know, you have to do more revenues just to break even than you thought, then that's sort of a time to step back and think, okay, is this business plan ready to be put into action? Am I ready to borrow this money? You know, that sort of thing. And so we weren't able to make that loan, but I think it's an example of where you had a candidate that on paper was probably eligible or could have made this loan. But then when you start digging down into the details, it's a little bit more risky to do. So, so there's a lot of that going on, you know, like Rob said, there's a lot of ownership changes going on right now. I think primarily baby boomers retiring and that sort of thing. And so, you know, like Rob said, you do have to put together projections, but it's really about how can you continue or improve on the previous owner's, you know, historical performance. And so you have to be thinking more along the lines. I mean, the SBA treats an ownership change and a startup similarly when it comes to underwriting. So, you know, you kind of have the same risk profiles if you're doing that. So we look for experience. Like Rob said, we really like the employees that are going to take over. We do like the owners to stay on for a period of time up to 12 months. You have to have some cash to be able to, you know, get the loan. And then, you know, we also like to have some sort of outside source of income that's separate from the business, if possible. So those are kind of the three things we look for on an ownership change. But again, experience is the number one criteria. You have to be able to demonstrate that you have the experience to manage that business. So anyway.
Great, thank you. You know what, Mike, what we say to people who are looking for loans and putting together a business plan and projection is, you know, it's great to get a loan, but once you get a loan, you're in deep trouble because you got to now pay it back. And if that plan is not reflecting what you can walk out, right, you just got yourself in trouble. Yeah. Right. So what Mike is talking about is you can't just do a projection. It's an action plan, right? So you can't just make up numbers. It's got to be an action plan that you can actually walk out because your livelihood, your family's, you know, 3-5 years of your life is tied up in this thing, right? And I remember one of the businesses, the first businesses that I got to coach, they had this amazing product. They had this carrier sleeping pod that for motorcycles. It's very unique, this is beautiful product, and they had a high demand. The problem was they started the business using credit cards, and they just couldn't fund their business. They were paying this enormous interest rates on their credit card, and no bank would touch them. And they had amazing product demand, but they couldn't fund it, right? And they ended up going belly up because no investor would touch it because they were so far behind. And so just starting out with good prudence, right? Okay, so I welcome any questions you have. Those of you who are in business and those of you are thinking about starting a business, I welcome any questions we have. And until we have questions coming up, and you're welcome to interrupt us and use your mic, or you can use the chat box. But let me Megan talked about some of her products and programs, but let's just kind of get into a little more of that. So Rob, loan products, programs, terms, what do they look like?
Well, at Columbia Bank, we're a commercial bank, and so we have conventional loans, but I think primarily what fits this audience is the SBA products, because when we as a bank can add that what we call government enhancement to the credit, it allows us to take on a little more risk. And our primary product from SBA is a 7A. We've alluded to that, this morning. And that product is really versatile. You can fund real estate acquisitions with it, and that loan can go out up to 25 years. You can fund large pieces of equipment, and we can go out further than 10 years. Typically, an equipment loan, we would only go out 10 years, but if the useful life of that equipment, let's say, for example, I've funded a feller buncher, is what they call a big piece of equipment for a logger, and it had a useful life of another 20 years. And so we were able to match that useful life and spread that loan out 20 years. And business acquisition funding, unless there's real estate involved, we usually look at about a 10-year repayment term. And so if you're talking about a business acquisition, I just put together one for $5 million, and you pay that loan back over 10 years, you've got a serious monthly payment. But this was a well-established business, and they were able to handle it. So
on that one, Rob, what were the terms?
The terms on that deal was a 10-year amortization. The rate was only fixed for 3 years, and then it would adjust every year after that, based on the Wall Street Journal Prime plus a margin. I believe the margin was 1.75. Okay. So you're looking at about a 5% interest rate over a 10-year period for a $5 million deal.
Okay.
But we can do that. The only time you run into prepayment penalties with SBA is when you have a loan 15 years or longer, and then it's only during the first 3 years, 5%, 3%, and then 1%. So that's usually not a factor. That's another real benefit for SBA. Using an SBA product typically will allow you to put a lot less down. That's always attractive as well. But it needs to be for an owner-occupied business. If you're looking at buying a duplex, this isn't the product for that. But if you are going to be actively involved with the business, or you buy real estate where you occupy 51% or more of it, that's the kind of product that would be available for those kind of transactions.
So what's a typical term for 7A? So just to clarify, Rob, when you say SBA product,
mm-hmm.
Can you just clarify what you mean by SBA product?
Yeah, SBA has several different products available, to fund different scenarios. The primary product of SBA is what's called 7A. And again, that's used for business acquisitions, some real estate deals. Business acquisitions are typically just a 10-year term. Real estate, you can go out 25 years. Well, in addition to that 7A, SBA has a 504 product, which is really only used for real estate or large pieces of equipment. And I won't get too into the weeds with that, but suffice to say, if you are looking for, to fund real estate, we would look at that, because the net interest rate on those deals is typically better than what we can do on a 7A. And then SBA also has some import-export type products as well. Some different lines of credit under that 7A program, cap lines. But, that's something that you would really want to lean on your account officer, your lender, Megan, whoever you're working with. And, we're tasked with presenting options for you, because there's typically, well, not typically, I say there are oftentimes more than one funding option available for you.
Okay, very good. Megan?
Yeah, our terms are typically, we're going to be at a higher rate than a bank right now. Our average is between 7.5% to 10%, depending on the risk profile. But we do have some loans that go as low as 5% if borrowers are in the smaller dollar loan category. We can lend anywhere from $25,000 to $3 million unsecured. If we have a security if it's secured by a government guarantee, such as the 7A, the 504, or the Bureau of Indian Affairs has a guarantee program that we utilize, as well as the USDA, which is a great option for many, many of the North Idaho communities because they have a rural business development guarantee. We can do up to 10 million on those. And so we will get kind of creative. Different guarantee programs have different requirements. The USDA is going to require your collateral to basically equal the loan amount, which is a pretty hefty burden for most people. But in a case where you're maybe buying a piece of real estate or something like that, that can be a really advantageous option to consider. We use the 7A primarily if we feel like there is insufficient collateral, and we are pretty we take a pretty big risk. We'll swallow a lot of risk on a smaller loan, but if we feel like there is even more risk than we want to take, that's when we'll pull the 7A guarantee in. But the majority of our loans we do without a guarantee to, one, save our clients some money, and two, because that's what we're designed to do. They're paying a higher interest rate already, so there's no sense adding the additional fees required for the 7A or other programs unless we feel like it's absolutely necessary. Our term, if you're financing real estate, we will go up to 20 years amortization, but we will only hold that loan for 5 years. Our goal is to move you into a bank in that term. If we have to refinance you again, we can do that. But typically our goal is to keep you 5 or 7 years at the longest and then kick you back out into a bank. But for our normal loans, we'll do 5, maybe 7 years, depending on the quality of the collateral and the asset that we're financing.
Okay. Very good. Thank you, Megan. Mike?
Yeah, our terms are similar to Rob's. I mean, we have a conventional lending platform and SBA as well. So not much more than I can add when it comes to those terms. Very similar to what Rob had discussed.
So just to clarify, when we are talking about SBA product or 7A, it's SBA guaranteed, but so sometimes people come to us and say, we want the SBA loan, and where do I go? Well, actually, SBA don't make these loans. It's the lending institutions who make these loans, and then they actually, if the risk is higher, as was mentioned, then they may use a protocol to get that loan guaranteed by SBA, right? It's backed by SBA guarantee. So it's not the SBA making the loan, it's the actually lending institutions backed by the SBA. So, and then there's a very specific criteria that they have to meet, and that's what they're talking about. The interest rate tend to be a little higher on the SBA guaranteed loans, but it's because the risk is a little higher, right? And then, so let's talk about application. Oh, okay, we have a question. Other than the things mentioned, what are some other red flags when first reviewing loan applications?
I can go. One of the things that I put down, and if you're in business currently, so you have an existing business, probably the worst thing is having low quality financial reports. We see this often, and by that I mean not really keeping track of your year-to-date performance, and so it's very hard to, as a banker, to analyze the risk or the ability to pay back the loan, especially at a time like right now, say in September, when you're 3/4 of the way through the year, and you're trying to rely on a tax return that's, 9 months old. And so keeping good quality financials, working with a CPA or having a good bookkeeper or using, QuickBooks, but, making sure it's up to date. One of the things that a lot of people I find, young business owners that don't really, they maybe take too much time to worry about is the balance sheet, and that's your assets and your liabilities. And that's really the document for a lender to look at to really assess the overall health of a business and its capacity to borrow. The income statement, is a moment in time, if you will, of where you've done up to that point. But I think just in general, having good quality financials prepared to bring to the bank for review is a critical step, but oftentimes is a mistake that that lender or borrower sometimes don't think about. So that's one of the main things that I said that try to avoid that.
I see a lot of poor quality financials because of the type of lending I do. And that is obviously a concern, but it's something that I'm comfortable working with and helping them connect to resources to improve that, because it's always a strategy for me that I don't want to make a loan to you to see you continue to provide poor quality financials. My expectation is you're going to get better, because I'm going to connect you with coaching, and sometimes I'll even require as a condition of the loan that you hire a bookkeeper in order to improve that, because I do think it's really critical for an owner to understand their financial position. So I would agree 100% with Mike on that. But the other thing that I see fairly often that is a huge red flag that I can't always fix is predatory debt. So that can take the form of it can be like a cabbage loan, or so the ones that you see online where they're like, oh, you can get $100,000 for your business in 24 hours. And the answer is yes, you can, but it's going to cost you, and it may well cost you your business, because what happens is they will insist on doing a draw every week from your accounts to settle their payment. And if you miss one, or you are a nickel short, they are going to jack your interest rate from the 10% it was at, or the 13%, or whatever they gave you initially, to 25, 50, even 65% interest per year. So those are really difficult to fix once you get in. So if it seems like it's too good to be true, it is. So don't do it.
And Bill, I might just throw this into, great comments, Mike and Megan, about the financials. And I really would add that a solid business plan helps, even with established businesses. If you're coming to us and wanting to take a leap to another level of your business, or acquire real estate or a substantial piece of business, a well thought out business plan with not just the rosy picture, but with maybe a plan B, because this last 18 months, 2 years has proven to us that it's nice to have a plan B, because there are things outside of your control that could shut your business down or severely curtail it. In a restaurant's a prime example. If you're going from the ability to full capacity to 50%, wow, what's your plan for that? And so I just add that is to a really well thought out business plan helps too.
Okay, thank you for those. How about credit score?
I've loaned to borrowers with credit scores in the 500s. That is not normal. And it is something that we have to really get our hands around why that was. And you have to be showing me that you are not on that same path. But we can get pretty in the woods on credit score, as long as the character, and like it could be like you had a bankruptcy because you had a medical situation hit your family. That's what it was in the case where it was a 500 credit score. And I will work with you as long as you can show me that's really why you had this issue and that you're doing the right things to put it in place. So credit score for me is secondary. Yeah, it goes back to that character and understanding why you are where you are today.
We're not quite that lenient at Columbia Bank. We really like to see at least a minimum FICO credit score of 680. We also, for smaller SBA loans now under 500,000, we pull a small score from SBA, which is kind of their proprietary program that, you know, leans on a FICO score as well. I don't know all the details of it. I don't know if anyone ever it really does, but we really, if you have a FICO score under 680, we have to have some strong mitigating factors, like Megan alluded to, as if there's you know, a medical or some tragedy in your past that wreaked havoc on your financials, and that could be a mitigating factor.
Another question. Okay, go ahead, Mike.
Well, I was just going to say the same thing with Rob. The small SBA loans require the scoring, and they lean heavily on the personal. So if you do have a challenge there, that might be a disqualifier. But we're probably somewhere in between Megan and Rob as far as how we treat the credit score. We don't really have a standard, but we really want to lean on that explanation if there is a lower score than sort of the 680 kind of, you know, score. But it is mostly a case-by-case basis versus if you're below it, you don't qualify. If you're above it, you do, kind of thing. So,
okay, thank you. That's really welcome news. Another question: is there a minimum loan amount required? Do you have a minimum loan that you wouldn't do below?
I think from America, from an SBA standpoint, we're probably at 50,000 and above to use that program. There's an express program that's a little bit, you know, a little bit more express, if you will. But from a standpoint of like a commercial loan, Numerica tiers it out to 50,000 and under. Our branches will handle that small business loan, and then 50,000 and above would come to our business services team, and then, you know, it would just go to the appropriate department in that team to handle it. So I would guess there's not really a limit when it comes to that, but it's just who would help you depending on the size of the loan.
Okay.
I can do anything, but if it's less than 25,000, I typically find there are micro lenders, SBA micro lenders, who can do the work more efficiently than I can. And so I will send those ones out unless there's a really rare circumstance in which I can get them a better rate. So I will do a loan if I am the best one to do it. But if I know there's other resources that are better than me, I'm going to send it out.
And here at Columbia Bank, real similar to Mike and Megan in that we do have a express line of credit product up to 25,000, but it's for businesses that have been in business for 2 years. They can provide us with 2 years of tax returns. But for those that are just starting out or looking for a real estate or a larger pieces of equipment, our cutoff is right about 100,000. However, if it's a part of, you know, a bigger relationship, that definitely impacts our ability to really handle that appropriately,
good,
efficiently.
Thank you. Another question. Okay, I'm just going to read it. Are you able to provide estimate amount of how much a lender may be able to loan before a business plan is made, i.e., knowing how much you can afford to borrow would be needed to determine your business plan?
That's the cart before the horse. Because you have to be able to, when you build up your business plan, what you're doing is understanding what market you're going into. So you have to understand what service you're offering, what you can charge for it, or at least have a ballpark, and how many clients you're going to have. That tells us what you can afford to borrow, basically. unless you're planning on supporting that debt out of your outside income. And then I suppose we could potentially tell you what you can afford, but it feels that's a little backwards. It means that you're not using the business to pay for itself, and we probably wouldn't make the loan in that case.
Yeah.
So
And the
this is
small,
my question. I don't know if you can hear me, but we're looking to buy an RV park essentially. So knowing how much space we would have to put in RV spaces would determine how much revenue we would be able to generate, knowing what area we'd be able to afford to buy real estate in, that kind of a thing. So to put together, I guess, a business plan without knowing the location of the park would be very difficult. Do you have any recommendations of how that might go?
I mean,
I would throw in a plug for the small business development centers here, Christy, in that they would, I mean, they can run loan scenarios for you all day long. And that would be a part of that business plan that they could help you work through and wrestle with, okay, if I'm looking at an RV spot with this many, spaces versus, versus substantially more or less, then they can kind of back into a value as well, because based on those spaces and your projected occupancy and your other variables, they'll help you wrestle with those numbers and give you a very good idea of what that would support. Is that correct, Bill? You and your team are pretty solid on that.
Yep. Be happy to help with that. And yes.
Yeah, but if you have, Christy, if you have an established business that you're looking at, we could look at, and I've looked at historic financials. If you have 3 years of tax returns or financials from the business, we could look at that and do those cash flows and give you an idea.
Okay.
And I would just add one last thing to that, especially if you're shopping around for an existing business, or you're putting together, in your case, maybe buying land and then developing a business, is, you have to have an idea already coming into that plan, how much cash you can provide to the project. And so, you're going to be in an SBA world, the minimum for any kind of startup project is 10% of the project cost. Most lenders don't go straight to the 10%. So knowing that you're going to be somewhere between 10% up to 20, 25% of the overall project, you can then back your way into what you can afford by saying, okay, if I have $100,000 saved up for this project, then that 10% of that is $1 million roughly. So, that would be a limiter on what type of property you would be looking to buy or that sort of thing. So you can help yourself. And that's also part of what Rob was talking about by going to the SBDC, is that they're going to help you structure a proposal to say, I've got this much to put down, bank, I need this much to borrow to make this project work, and that sort of thing. So you can help yourself when you're in that pre-planning stage or in that business development stage by knowing what you have available from your own personal cash reserves and that sort of thing to put into any project.
Exactly, like what Mike is saying. And then you can use that to build that budget to figure out how many spaces you are going to need to support that debt. And that will help you basically line out any properties that exceed the value or are insufficiently large to support the number of spaces you need to service the debt.
Yep.
Perfect. Thank you.
Great. So we're almost out of time. So let's just go around, starting with you, Rob. Okay, any last thing you'd like to, you want the audience to know?
Thanks,
Just
Bill.
a few moments.
Yeah, and the next item on your slide there, I think, is very important. And I want to just emphasize that this process, especially when using an SBA product to fund it, takes a while. If you put together a business plan overnight, it's probably not nearly as thought out as it should be. So that process can take weeks and months, and should be, because if you're diving into something, we want you to thoroughly analyze that industry and that opportunity. And so just understand that the process can take months. It's not like buying a residential home where if you're buying commercial real estate, don't let the realtor put a 30-day close on it, because it just, it's a different ballgame and it takes time. So I would say we here at Columbia Bank, our best practice is, once we get a complete application package, which includes the business plan and financials and our application, we say that typically it'll take, especially if it's real estate, 90 days to get it closed. Now, do we shoot for 60? Absolutely. But we say 90 because more times than not, stuff comes up and it takes time. So I want to emphasize that, Bill.
Thank you.
Yeah,
Megan?
I would add to that as well, especially if you're starting a business. The due diligence phase, I call it, there's no set standard, but one of the assessments that we talked about at the very beginning of the webinar is that character assessment. And one of the probably the best way to determine if there's any interest on the financial institution to move forward with a startup project is how much due diligence you brought before you even got to us. And so that's the planning, the budgeting. So don't be afraid, to write a plan and rewrite it and criticize your own work and, challenge your assumptions, because that's really what's going to make the biggest difference when you come to the table is, when we look at it, I kind of say this a lot, sometimes we get business plans that are heavy on mission statements and light on, the assumptions on how they're going to do their business. And I think that the best business plans don't have to be in any kind of fancy casing or fancy print. They really just have to be well thought out. And like Rob mentioned, well thought out is different for every borrower or business owner, but it really needs to be, you could be in the due diligence phase for a year before you are ready to launch or do that sort of thing. And so that's a really big piece of the puzzle that we are looking at with these business plans. And so don't be afraid to modify them and adjust them and scrutinize them. And also one last thing is, don't be afraid to, show a loss the first 6 months, 12 months. That's probably more realistic than making $150,000 the first year. I tell people a lot that, if you send me a business plan and it shows you're going to make $200,000 the first year, well, everybody would be doing that. And so that's the first red flag. But second of all, if you need a $100,000 loan and you're going to make $200,000 in the first year, then maybe you should just pay it back in the first year. And that's like, I don't want to pay it back in a year. But so that's the challenging those assumptions piece where, we've had, business plans that were very detailed that showed a loss the first year. And that's kind of a realistic projection, but they had a plan. And the plan was it was going to take, 18 months to ramp up to get to break even. And then profitability would come by year two. And, but sometimes business owners or, business prospect owners are afraid to show that because they think they have to show this best picture to the bank to be able to get a loan. But the reality is what we want is a quality picture. We want quality information. We want well thought out, assumptions and that sort of thing. So that's where that due diligence is, don't put a business plan together in a couple of weeks and then come to the bank and ask for money because you probably haven't thought everything through. So that's a big part of like a startup that, we're looking for to be able to take that risk on and make that loan.
Great.
For me, the other thing that I hear is, for me, when you hear no, it's typically not today. It doesn't mean no forever. It doesn't mean no, this is a bad idea. If it's a really bad idea, trust me, I will tell you. But if it is, a daycare and a massage parlor, that was a bad idea. There's no way I'm ever funding that. Kid you not, that actually came through. And so that's a no forever. But most of the client times I get clients, If I tell you no, it's because you haven't addressed all of the issues, and I'm going to give you that feedback and tell you where you need to go. So basically, I think you need to consider, and don't be afraid to come and ask. I mean, I'm more than happy to meet with people. I have clients who I have been working with for multiple years who are just now at the point where they're ready to actually take debt because they have revenues and can repay, or they have a sufficient plan that we can finance. So if you want to come in and ask those questions, I'm more than happy to give you really candid feedback and then send you back out to the members of the community who can help you build it up to get it to where either I can say yes, or in some cases I can say, wow, this is really good. You're too good for me. I need you to go talk to Mike and Rob because I can't fund you if you're bankable either. That's the other thing. So I'm perfectly happy to talk to you. But if you're bankable, you're not my client, and that's okay.
Cool. Well, this has been really good. Thank you. Thank you, Megan. Thank you, Mike. Thank you, Rob. Great info. Really, I think insightful and helpful. I think we've been losing people, but those of you who attended, thank you for coming. Again, one of the things that we want to help you to do is ask better questions. To build a good business plan, you gotta ask better questions than just kind of just doing it by the seat of your pants. So all of these webinars that we're offering, they're at no cost, easy access, NISBDC.com. You're welcome to leverage it. If you need coaching, obviously we're available. If you're in Washington, there is SBDC in Washington and other SBDCs in the area. Do leverage those resources. Because they'll help you. So once again, thank you to our panelists. You guys were awesome. Yeah, it was a pleasure hearing you. And those of you attended, I wish you all the best in your journey. Okay. Goodbye.
Thank you.
Thank you.